Hey everyone, and welcome back to Fingraph India. So if you're gearing up for your CA, CS, or BCom exams, or honestly, even if you're just dipping your toes into income tax for the very first time, you are in exactly the right place. Today, we're doing a deep dive into an absolutely crucial, highly testable explainer. We're going to master Section 10, which handles the totally unique apportionment rules for spouses governed by the Portuguese Civil Code. Now listen up, because examiners literally love this topic. Why? Well, because it completely breaks the standard everyday tax rules that apply to the rest of India. You know, when paper setters want to see if you actually understand the mechanics of the law, rather than just blindly plugging numbers into a formula, they'll sneak a Section 10 adjustment right into the middle of a massive 14-mark computation question. So grab your notes, get comfortable, and let's make absolutely sure you lock down those full marks when this inevitably shows up on your exam. Okay, let's kick things off with a pretty fundamental question. Are husbands and wives always taxed purely as individuals everywhere in India? You know, if I pose this question in a live classroom, practically everyone just nods and says, well, yeah, of course. Because normally, under the Income Tax Act, a husband files his return with his PAN, the wife files hers with her PAN, and they're assessed completely separately. You don't just mash their salaries together just because they tied the knot, right? But if you've been studying tax for a minute, you know examiners live for the exceptions. And what we're looking at today is a really fascinating geographical anomaly that just flips this baseline rule completely upside down.
So here's our game plan for this explainer. First, Goa's unique tax rule. Second, the community of property. Third, the 50-50 income split. Fourth, the salary income exception. And finally, a quick exam revision summary.
All right, moving right along to our first segment, Goa's unique tax rule, an incredible geographical anomaly in the Income Tax Act.
Take a look at this. This is the official excerpt straight from the Ministry of Finance. I always want you to see the actual raw phrasing we're working with. This right here is the bare text of Section 10, dealing specifically with the apportionment of income between spouses. Now, I know what you're thinking. Legal jargon can look like a massive, intimidating wall of text, right? All those notwithstanding anythings and provided that's. But don't sweat it. We're going to chop this up into totally manageable, bite-sized pieces so you aren't just rote learning it. Once the core logic clicks, you're never going to forget it.
Let's start with literally the very first thing you need to scan for in any exam problem, the geography. Section 10 doesn't apply to all of India. It only kicks in if a husband and wife are governed by the systems active in the state of Goa, the Union Territory of Dadra and Nagar Haveli, and the Union Territory of Daman and Diu. So if you're reading a computation problem and it casually mentions a taxpayer living in one of these three spots, alarm bells should instantly be going off in your head. That is your cue to activate the Section 10 framework. A super easy memory trick for the exam, just think of the West Coast regions with Portuguese influence, Goa, Daman, Diu, Dadra, and Nagar Haveli. So if the question says Mr. A, resident of Delhi, you just ignore this rule. But Mr. A, resident of Goa, boom, Section 10 is in play.
Now that we know exactly where to look, let's deconstruct the legal framework behind the community of property.
What's genuinely super interesting here is the history behind it. Why do these specific West Coast territories have this wildly different rule? Well, it's because they operate under the Portuguese Civil Code of 1860, specifically a legal system called COMMUNIAO DOS BENS. Okay, write that down. You absolutely have to memorize that exact phrase, COMMUNIAO DOS BENS. It literally translates to the community of property system. Examiners actively hunt for this keyword in subjective answers, and dropping it will definitely secure you full marks. Under this unique system, when a couple gets married, their assets and the income from those assets basically become a communal pot. Legally, it belongs to both the husband and the wife together as one single communal pool.
Now, put your tax hat on for a second. If the property and the income are essentially communal, you'd probably think, hey, the income tax department is just going to clump the husband and wife together and tax them as one giant combined entity, right? Actually, no. Look closely at Clause A from Section 10. It explicitly states that their income shall not be assessed together as that of such community of property, meaning the tax department legally cannot treat them as an association of persons, an AOP, or a body of individuals, a BOI. Think of Clause A as a shield. It completely blocks the assessing officer from lumping their incomes together. And that's a huge deal, because if they were combined, the couple would instantly get shoved into the maximum marginal tax bracket. So this clause saves them from a massive, unfair tax hit.
So, if we can't tax them as one big entity, how do we actually do the math? Let's check out the 50-50 income split for non-salary sources. All right, so if the government can't combine them into a single AOP or BOI, how do we split up this communal income pot? Clause B lays out a brilliantly simple solution. Any income under any head, with one major exception we'll hit in a second, has to be divided perfectly equally between the husband and the wife. A strict, mandatory 50-50 split. Let's make this real. Say they run a joint family business in Goa, making a neat 20 lakhs in profit under the business or profession head. You absolutely do not tax the husband on all 20 lakhs. Nope. You allocate 10 lakhs to the husband and 10 lakhs to the wife. That's it. It's the exact same deal for rental income from house property or capital gains from selling communal assets. You literally just take the final number and chop it right down the middle. Which brings us nicely to Clause C. How does this actually look in the final tax computation? Well, once you've made that clean 50-50 split, the law says this divided income is included separately in the total income of the husband and the wife. Going back to our business example, each spouse takes their 10 lakh slice, drops it into their own separate individual tax return, and boom, from there on out, the regular Income Tax Act takes the wheel. They each claim their own basic exemption limit, they each get to claim their own Chapter VIA deductions, like ADC for their own investments, and they calculate their tax separately. It's incredibly systematic and honestly really fair.
But wait, here is where things get a little tricky, and honestly, where a lot of students drop easy marks. The salary income exception.
This is Clause D, guys, and it's absolutely crucial. It is the exact trap examiners love to set. We just established that income gets divided equally, but look at the brilliant logic the lawmakers used here. While passive, communal property income, like rent from a building they own together or profits from a joint business, is split 50-50, actively earned salary is completely fenced off from this rule. You never, ever divide salary. The law basically says, look, your physical assets might be communal, but the physical and mental sweat you put into a 9-to-5 job, that is purely individual.
So Clause D lays it down clearly. If either the husband or the wife has income under the head salaries, that specific chunk of income goes into the total income of the spouse who actually earned it. Let's do a quick exam scenario. Husband in Goa earns a 12 lakh salary as a software engineer. That entire 12 lakhs is taxed 100% in his hands. You do not chop it into 6 lakhs for him and 6 lakhs for his wife. No way. On the flip side, if the wife makes 5 lakhs working as a teacher, that 5 lakhs is fully taxed in her individual return. Think about the underlying logic. A salary pays for personal effort, so 100% of it stays with the person who actually clocked in and did the work. Makes total sense, right?
All right, let's lock all of this in with a rapid-fire, step-by-step exam revision summary.
When you're staring down a massive computation problem in the exam hall, just follow this foolproof algorithm. Step 1, check the geography. Read line 1 carefully. Is the taxpayer in Goa, Dadra and Nagar Haveli, or Daman and Diu under the COMMUNIAO DOS BENS system? If yes, game on. Activate Section 10. Step 2, make sure you do not assess them together as an AOP or BOI. Keep their tax sheets totally separate. Step 3, isolate the salary. Find the income under salaries and assign 100% of it directly to whoever earned it. Don't touch it. Step 4, take literally every other head of income, house property, capital gains, whatever, and just split the net figures right down the middle, 50-50, adding it to their separate total incomes. Stick to those 4 steps, and I promise you cannot get this wrong.
Master the exception, master the exam. That is our golden rule here at Fingraph India. Section 10 perfectly proves why understanding the actual logic behind a law is a million times better than just blind memorization. Knowing exactly how to navigate this Portuguese Civil Code apportionment is definitely going to give you a massive edge over everyone else taking the exam. I really hope this explainer made Section 10 totally transparent and super easy to apply. If this helped things click for you, smash that like button, share this explainer with your study groups, and make sure you're subscribed to Fingraph India. Oh, and hit the bell icon so you don't miss our next big tax explainer. Keep studying smart, remember the logic, and let me leave you with this thought. What other tax rules do you think are hiding in plain sight based purely on geography? Think about it, and I'll see you in the next one.